TSS and BTE have joined forces.
Context,
Power.
edge.
The new paradigm of trading.
You know, when we look at the financial markets,
Yeah.
we usually expect a certain level of, logic. I mean, if the surface of the ocean is completely calm, glassy, not a single ripple in sight, you naturally assume the water underneath is peaceful too.
Yeah, you would. But what if I told you that just beneath that perfect placid surface, there is an absolute hurricane raging, like massive rip currents, sharks in a feeding frenzy, utter chaos.
Right, and yet, when you look at the surface, it's just a quiet, boring, flat line on a chart.
Exactly. It is a terrifying image, honestly, and yet it is the defining characteristic of some of the most dangerous market environments we ever see. I mean, the illusion of calm masking extreme structural fragility.
Because we tend to think that a quiet market means a safe market, right?
Mhm.
But often, it's the exact opposite.
Oh, 100%. It's the absolute opposite.
Which brings us to the mission for today's deep dive. So we are looking at a stack of highly detailed, almost forensic daily trading notes from a financial analytics firm called Spot Gamma.
Yeah, these notes are incredibly dense. Super dense. We've got their morning and afternoon dispatches covering a single, wildly contradictory week in the markets, July 6th through July 10th, 2026. And the data in these notes is screaming that the hurricane is already here. We just, can't see it on the evening news.
Right, because the surface is so quiet.
Exactly. So by the end of this conversation, you are going to be able to read the hidden mechanical forces, basically the invisible gears that are secretly steering the stock market, so you can actually read between the lines of everyday financial headlines like a pro.
Yeah, because we are ultimately looking for the why behind market movements here. I mean, we aren't going to get bogged down in whether a specific stock just went up or down $1.
Right, that's not the point.
No, we need to examine how the massive multi-billion-dollar positioning of market makers literally dictates whether the broader market slowly, lazily drifts or whether it violently snaps. Because it is all math, and, well, the math just doesn't care about human emotion. Okay, let's unpack this, because to really understand the stock market right now, you actually have to look at the derivative market that is holding it hostage. So let's start with this setup for that week.
Yeah, let's look at July 6th.
Right. The notes immediately flag that the S&P 500 is completely blanketed in something called positive gamma, specifically with the 7,500 strike price acting as this massive, unavoidable magnet. So let me try an analogy here.
Go for it.
Is positive gamma essentially like going bowling, but with the bumpers pulled up? Or maybe like a thermostat set perfectly to 72 degrees? Like, if the market dips a little, a machine automatically buys. If it rips too high, the machine sells. It just forces everything into a tight, calm little box.
I mean, the bowling bumpers analogy works perfectly, yeah.
Yeah.
But let's look at why those bumpers are actually there, mechanically speaking.
Okay.
When we say the market is in a positive gamma environment, we are talking about the specific risk profile of the dealers, like the massive institutional market makers who facilitate all these options trades.
The guys on Wall Street making the actual trades happen.
Exactly. When you buy or sell an option, you need someone on the other side of that trade. The dealer is that someone. But the dealer doesn't want to bet on whether the stock market goes up or down.
Right, they aren't gambling.
No, not at all. They just want to collect small transaction fees. So to stay entirely neutral, to, avoid taking on any directional risk, their algorithms force them to constantly hedge their books.
Okay, but how does that hedging turn them into a bumper? Like, how does that hold the market in place?
Because of the math of positive gamma, when dealers hold this specific type of options portfolio, their objective of staying neutral forces them to trade against the market's momentum.
Meaning what exactly?
So if the S&P 500 starts to drop, the math on their books forces them to buy futures to rebalance and stay neutral. If the index rallies and goes up, the math forces them to sell.
Oh, wow. So they're acting as a massive multi-billion-dollar shock absorber. But wait, why would they want to do that?
Well, it's not about wanting to do it. The math compels it. Their hedging activities actively suppress market volatility, whether they want to or not.
It's just automatic.
Completely automatic. And this is why throughout this entire week in the data, the 7,500 level and a secondary level at 7,490, they constantly acted as stubborn support and resistance. They called it a hedge wall.
Right, a literal wall.
Yeah, because every time the market tried to sell off, the dealers mechanically bought. Every time it tried to rally, they mechanically sold. And for you, the listener, this is crucial, right? If you are sitting at home watching your retirement portfolio and you see the major indices barely moving for days on end, you might think the market is just tired or there's no news.
Or it's just a boring summer week.
Exactly. But in reality, the options positioning is quite literally mathematically forcing the market to stay still.
But wait, this brings up a glaring contradiction in the data. Because if the S&P 500 is so perfectly bumpered and the market makers are absorbing all the shocks, why do these daily reports repeatedly, almost obsessively, warn about a looming market spasm?
Ah, yes. The spasm.
Yeah. They keep warning about a solid market correction hitting at any moment. If the bumpers are up, why are the analysts sweating so much?
To understand the fear, we have to look past the S&P 500 itself and look at a very specific metric in the data called the KOR1M index.
Okay, I'm going to need a translation on that. What is KOR1M?
Yeah, it stands for the 1-month implied correlation of the stocks inside the S&P 500.
Implied correlation.
It simply measures how closely the 500 individual stocks in the index are moving together. Are they all going up at the same time, or is half the market crashing while the other half is soaring?
Got it. So how synced up they are.
Right. And historically, whenever this index drops below a critical risk level of 8, it signals extreme danger. And over the course of this single week, while the S&P 500 was totally flat, the COR1M plummeted.
Like how far?
It started near 5, dropped below 4, and eventually hit a one-year low of 3.44 by Friday.
Okay, so correlation is dropping like a stone, meaning the stocks are completely unsyncing from each other. But what does that actually look like in the real world?
It looks like dispersion. Dispersion is the hurricane underneath the calm ocean surface.
Okay.
Underneath the index, individual single stocks are actually going crazy. Some are surging violently upward, driven by massive speculation. Others are cratering. But because they are moving in completely opposite directions, when you average them all out to get the S&P 500 price...
The math cancels out to zero.
Exactly. The index doesn't move.
I get it. It's like two incredibly strong people playing tug-of-war. The rope itself isn't moving left or right, so it looks calm. But there is a massive amount of tension in the system. The tension is just hiding.
What's fascinating here is how that hidden tension warps the pricing of risk across the entire market.
How so?
Well, the data shows the VIX, the famous fear gauge that measures the volatility of the whole index dropping to a one-month low. The S&P 500 implied volatility was stuck in the single digits. It looked completely asleep. But at the exact same time, the volatility on the Nasdaq, the tech-heavy QQQ, was roaring in the 20s. Individual tech stocks were experiencing wild multi-percentage point swings every single day.
Hold on, I want to push back on this because it feels completely counterintuitive.
Sure, what part?
You're telling me that the fact the surface of the market is so calm, while the underlying stocks are moving so wildly that the calm surface is actually proof that a crash is coming. That just doesn't make sense to me. Usually calm means safe.
I know, but it is the disconnect that makes it dangerous. Dispersion cannot last forever. You can't have half the market in a roaring bull phase and the other half in a bear market indefinitely.
So something has to give.
Exactly. Eventually, those deeply divided stocks will sync up again. They will correlate. And when they do, the tension in that tug-of-war rope violently snaps, and all that hitting volatility floods into the broader index at once. That is the spasm.
Okay, here's where it gets really interesting for me. Knowing that there's this invisible tension, how do the professionals, the smart money, actually trade this?
Well, they don't just sit on their hands, that's for sure.
Right, because the analytics firm doesn't just point out the problem. They give a very specific strategic recommendation for this exact setup. They repeatedly advise buying what they call short-dated deep QQQ put flies.
Yeah, a put fly or put butterfly is a multi-leg options trading strategy. And in this specific low correlation environment, it is basically a highly calculated, incredibly cheap lottery ticket.
Okay, break that down for us. Why is it cheap and what makes it a lottery ticket?
It is cheap because, as we just discussed, the index volatility, the VIX, is priced so low. Options are essentially insurance policies.
Right, you're buying protection.
Yes, and when volatility is low, it means that the market is pricing in absolute calm. The insurance premiums are on clearance because the market doesn't expect a fire.
So they're practically giving the insurance away.
Exactly. So traders can structure these complex options trades for pennies. If the market stays calm or just drifts around, the trade expires worthless, but the trader only loses a tiny, insignificant amount of capital.
But what if it drops?
If the Nasdaq suddenly drops, violently say, more than 1% in a day, this structure wakes up. its value expands exponentially because of the gamma sensitivity at those lower strike prices.
Wow.
It's an asymmetric bet. You risk a tiny bit of capital to make an absolute fortune, but it only pays out if the spasm actually hits.
So it's like buying comprehensive flood insurance in a desert for $1 right before you know a massive unannounced monsoon is scheduled to arrive.
That is a perfect way to put it.
But let's look at how this plays out with individual stocks, because the notes give a brilliant real-world example of this single stock chaos operating while the index does nothing. I want to look at SpaceX, ticker SPCX.
Ah, yes. The index inclusion play.
Right. The notes mention that SpaceX is scheduled to be added to the Nasdaq 100 index that week. Now, standard financial textbook theory says that index inclusion equals passive buying from ETFs, which means the stock should automatically go up.
Right. That is the universal expectation. Millions of dollars of passive funds are basically forced to buy the stock.
But that's not what happened here. The data shows SpaceX actually dropped below its IPO debut price of $148. The standard theory totally failed. Why?
Because of the options market.
Exactly. The notes reveal it's because options traders were selling massive amounts of puts, specifically 25,000 August 125 puts. But I need you to explain the mechanical gear turns here. Why does someone selling a put option cause the actual stock price to drop despite the passive buying from the index inclusion?
This is a perfect example of the options tail wagging the equity dog. Let's slow down and look at the mechanics.
Please do.
The traders knew something. The passive ETFs didn't really care about an upcoming lockup expiration.
That's the date when insiders can finally sell, right?
Right. It's when SpaceX insiders, employees, and early investors would finally be allowed to sell their shares on the open market. Anticipating that massive wave of insider selling, options players stepped in and aggressively sold put options to harvest the elevated fear, the high premiums surrounding that event.
Okay, but remember the dealer on the other side.
The shock absorber who has to stay neutral.
Right. When the dealer buys those puts from the traders, the dealer suddenly inherits the risk that SpaceX stock might crash.
Oh, I see.
So to hedge that specific risk and get back to neutral, the dealer's mathematically forced to go into the open market and short the actual SpaceX stock.
Wait, really?
Yes. So you have this massive wave of forced short selling from the dealers, driven entirely by the options market, and it completely overwhelms the buying from the index inclusion.
That is wild. The mechanics of the derivative market literally broke the textbook rules of the stock market.
And it wasn't just tech stocks acting wildly either. The data caught smart money aggressively rotating into energy via out-of-the-money options.
Now, out of the money just means options that are currently worthless unless the stock makes a big move, right?
Correct. They are cheap bets on large directional moves, and we saw massive moves. Devon Energy had its September 47.5 calls double in value, up 100%. BP September 40 calls jumped 56%.
So while the main S&P 500 index was frozen, savvy traders were using cheap options to hunt for these violent single stock and sector-specific rotations.
But this delicate balance, this dispersion game where some stocks are up and some are down, it only works in a vacuum. It relies on the market being isolated from major external forces.
What happens when the real world kicks the door in?
Which is exactly what happened right in the middle of this week.
Yeah.
We get a geopolitical tremor. The notes point out that on Wednesday, July 8th, the Iran war reflames.
A major macro shock.
Exactly. This macro shock pushes WTI crude oil up 2.5% to $74.05 a barrel. And immediately, you can feel the tone shift in the data. The analysts aren't just talking about a theoretical spasm anymore.
No, they are looking at a historical ghost.
Right.
If we connect this to the bigger picture, this is exactly why dispersion is so incredibly dangerous. A special note from the founders draws a very deliberate, chilling parallel.
What did they say?
They point out that the market has extremely low correlation. There is a massive divergence between Nasdaq volatility and S&P volatility, and suddenly we have an external macro shock flaring up regarding oil, which immediately impacts inflation and interest rates.
Oh boy.
The analysts state plainly that this is the exact recipe for a July 2024 style VIX move.
You mean August 5th, 2024. That was the day the VIX spiked to 60. It was a complete liquidity black hole. But wait, surely the market makers see this coming. Like, if a macro shock hits, why can't they just manage the flow like they always do?
Because a macro shock breaks the fundamental premise of dispersion. Let's go back to the bowling bumpers and the tug of war.
Okay.
When single stocks are disconnected, the dealers can manage the flow. They buy a dip in tech, sell a rip in healthcare. It balances out perfectly.
Right, because things are moving in opposite directions.
Exactly. But an external geopolitical shock, like a war escalating and oil spiking, doesn't care about dispersion. A macro shock hits everything at once.
Oh, I see.
It forces all those disparate, disconnected stocks to suddenly move in the exact same direction simultaneously.
The tug-of-war rope snaps, and correlation goes from 0 to 1 in an instant.
And when everything drops at once, the market makers, who are supposed to act as the bumpers, get completely overwhelmed.
The volume is just too high.
The volume of hedging required is so massive that the system chokes on its own data. The bid-ask spreads widen out, liquidity completely vanishes, and the very mechanics that were providing stability suddenly vaporize, causing a catastrophic air pocket drop.
That is the true danger of a low correlation environment. It is genuinely wild to think about. It's like the financial equivalent of a fault line, building up immense pressure for years while the city above just goes about its business completely oblivious.
Yeah, that's exactly it.
And what's crazy is how the broader public misinterprets this data. Later in the week, on Thursday, July 9th, the notes highlight a chart that's going viral on social media.
Oh, I love this part.
It shows something called a record low put-call skew. And the mainstream narrative, the Twitter sphere, is screaming, everyone is a bull, everyone is greedy, they're just gorging on call options.
The analysts flag this specifically because it perfectly illustrates the danger of what they call level 1 thinking.
Level 1 thinking.
Yeah, it is looking at a chart, seeing the line go down, and making the most obvious superficial assumption without understanding the actual mechanics underneath.
Okay, I want to challenge that level 1 thinking. If a record low put-call skew doesn't mean retail investors are buying calls in a blind euphoric rage, what does it actually mean? Because to a normal person, a low put-call ratio means nobody's buying downside protection.
We have to look at who is doing the trading and what they are actually doing. It is not that retail investors are just endlessly buying call options.
But who is it?
What is actually happening is that the buy side, the large institutions, the sophisticated hedge funds, are selling options to harvest the sky-high premiums on these volatile tech stocks.
Wait, I have to stop you there.
Yeah.
If the geopolitical risk is as high as you just said it is, with wars and oil spiking, why would the smart money institutions be risking everything just to collect a few pennies in premium by selling options? That seems incredibly reckless.
It does seem reckless, but in a low volatility index environment, institutional funds are starved for yield.
They need returns.
Desperately. So they step in to act as the casino, collecting the premium on single stocks where volatility is still high. They think they can manage the risk. But here's the ironic twist.
Hit me.
When the buy side sells these options, the dealers on the other side are the ones buying them. And when the dealers buy them, it feeds the dealers more.
I'm positive gamma.
Yes. It reinforces the very bowling bumpers we discussed at the beginning.
Oh, wow.
The buy side is harvesting premium to make a quick buck, which locks the dealers into a massive positive gamma position, which further suppresses index volatility, which further lowers the correlation index.
It is a self-reinforcing loop of structural fragility. The institutions are literally building the bomb they are sitting on.
Exactly. And nowhere is that fragility, that absolute mania, more apparent than in the semiconductor space during this week.
Right, the AI and chip euphoria peaking. We see NVIDIA generating a staggering $1.6 billion in delta notional in a single day.
It's massive.
Traders bought 37,000 July 200 calls and 42,000 September 195 calls. But you just threw out the term delta notional. For those of us who don't run a hedge fund, what does that actually mean?
So delta notional is a way of measuring the true footprint of leverage in the options market. When you buy a call option, it might only cost you a few $100s, but that option controls 100 shares of the underlying stock.
Okay, so it punches above its weight.
Exactly. Delta notional calculates the actual dollar value of the stock that the market makers have to buy to hedge your tiny option trade.
Ah, I get it.
So when we say $1.6 billion in delta notional, we mean that a relatively small amount of money spent on NVIDIA options forced the dealers to buy $1.6 billion worth of actual NVIDIA stock just to balance their books.
It is just a fire hose of capital forcing the stock higher.
Yeah.
And that euphoria culminated at the very end of the week.
July 10th.
Yep. The data highlights the U.S. trading debut of SK Hynix. This wasn't just any IPO. It was the largest first-time foreign listing ever.
Huge deal.
It priced at $149 per share, and it was oversubscribed by more than 7 times. The demand from investors was absolutely insatiable.
And this is the ultimate symbol of the contradiction we've been discussing. I mean, you have this absolute white-hot, blinding euphoria in the semiconductor sector, 7 times oversubscribed, for a massive IPO operating in the exact same market at the exact same time as this terrifying, mathematically proven spasm risk in the broader index.
It's totally split.
Yeah, you have microscopic index volatility resting on a foundation of historically low correlation that could snap at any moment due to a single macro headline.
So what does this all mean? We started this deep dive looking at a seemingly boring flat S&P 500 pinned stubbornly at 7,500. It looked like the market had just gone to sleep for the summer.
It did look that way.
But by looking under the hood, by tracking the plunging correlation index, the massive dispersion, and the hidden mechanics of delta hedging, we discovered a market that is deeply divided. It's a tug of war between extreme tech euphoria and the looming threat of a violent volatility-driven correction. To me, it proves that true financial literacy isn't about watching your portfolio tracker go red or green.
No, not at all.
It's about understanding the invisible structural forces, the gamma, the dealer positioning, the options flow that dictate why the market is moving, or in this case, why it's being forced not to move.
I couldn't agree more. In a market that is currently priced for absolute perfection, where index volatility is in the single digits despite global conflicts and economic uncertainty, understanding these underlying dynamics is no longer optional.
You really have to know it.
You do. The surface of the water will not tell you when the hurricane is coming. Understanding the mechanics is the only way to avoid being completely blindsided when the math inevitably reverts to the mean.
It leaves you with a lot to think about. We've established that positive gamma creates a protective bumper, forcing market makers to buy dips and sell rips, stabilizing the system. But here is a final thought to mull over, something to consider that is the logical extreme of everything we've discussed today.
What's that?
Well, what happens if an unexpected geopolitical shock is so severe, so sudden, that it doesn't just bypass those positive gamma bumpers? What if the velocity of the drop forces the market makers to immediately flip their massive multi-billion-dollar books from positive gamma to negative gamma?
Oh, man.
Right. In that scenario, the dealers are no longer buying the dip to stay neutral. Suddenly, the math forces them to actively sell into the drop to hedge their risk. If the very entities responsible for providing stability suddenly become the largest source of forced, mechanical selling, could the very math designed to buffer the market actually engineer its most spectacular collapse? We'll leave you looking at the calm surface of the water, wondering exactly what is swimming underneath.